Welcome to Bar Chart's series of webinars designed to educate you about a variety of market concepts, inform you of the features and tools Bar Chart provides related to these concepts, and finally, to give you some trader's insight to help you make a more informed investment decision. Today's subject, protecting profits with options. Now, although there's many option ideas to protecting profits as there are option traders, we're going to look at a very specific strategy called a no-cost collar. And the goal of the no-cost collar is to offset the purchase price of a put, out of the money put, with the proceeds of selling an out-of-money call. Now, the benefits of a no-cost collar, it removes this emotional uncertainty of significant price losses or profit losses in this case, while allowing the investor to choose the time and the price of the downside risk they want to take on. The trade-off, though, is the covered call portion of the no-cost collar limits the upside profit potential. Now, if timed correctly, the investor could continue to maintain ownership of the stock and still reap greater reward benefits. So, hello everyone, my name is John Rowland, and today I'm going to help you guys look at exploring this concept, the variables that are associated with it, and we're going to look at some of Bar Chart's tools to help us in assessing this multi-option strategy. I'm going to give you some rules, more like food for thought, to help you better time and execute this strategy. But before we get started, please everyone welcome my partner and our moderator for today, Bar Chart's Project Director, Jean Baker. Hello, Jean.
Good afternoon, John. Hello to everybody else out there.
So we were talking pre-webinar, get a little crappy rainy day in Chi-Town today, huh?
Yeah, again. and you were telling me that you're enjoying another nice sunny day out by where you are.
72
so
and sunny, yes.
Rub it in, John. Rub it in.
I don't mean to do that to you, but
that's
anyhow,
okay.
I know. All right, Jean, you ready to get started today?
Absolutely. Let's go.
All right, let's get it going. All right, just remember that today session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involve risks and best made based on the advice of a qualified financial professional. Understand that options trading is not for everyone, and under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material you receive through barchart.com or our services. Okay. So first I want to just kind of talk about this concept of why it's important to have a protective plan. In other words, why do we want to make sure we protect our profits? So here I'm on our main page, and under the stock section, here's stock market ideas. So back in January, we did a webinar called Trends for the New Year, and we discussed about picking 22 stocks for the year 22 for this upcoming year. And what we can see is, well, first of all, if you're interested in that webinar, there's a link right here. But if we look at the profiles of these companies and just kind of look at their price action, we can see that many of these companies that are in this webinar, some of them are at 52-week highs, and that might be important for us to learn some strategies. If we had invested in these stocks, what we would want to be able to lock in some of the profits, or at least protect ourselves from potential price reversal. So let me just move away from this page, and under tools, you'll find where it says portfolios. And so what I did was I took the 22 stocks that were in this webinar and I created a hypothetical portfolio. And you can see here that, we're about 1 quarter into the year, a little bit more than 1 quarter of the year. And our portfolio is up about 9%, which is not bad considering the year that it's been. But more importantly, what I want you guys to notice here is that our profits are concentrated in just a handful of stocks. Now, this is a very real and common phenomenon of portfolio management. You're going to find that about 10% of your portfolio is going to account for about 90% of your profits. And so let's look at our example here. We can see that our top two, Mosaic and Alcoa, is up about $6,300, or about 65% of how much this portfolio is up year to date. And so what it's important for us to understand is that importance of learning how to protect the profits. Because if one of these two stocks, let's say, took back some of those profits, it would have a huge detrimental effect on our portfolio's overall performance. All right. So the strategy itself is we're going to sell calls above current price to collect premium. Then we're going to use that premium to buy puts below current price. And this is called a collar. Now our hopes, really our plan, is to use the premium collected to buy a downside put protection of those individual stocks in our portfolio, but more importantly, those that have large winnings, right? And protect those profits. So what I want to do is I want to kind of offer up some ground rules or food for thought to help you in the selection process of both our calls and our puts. So let's do the calls first. So the first thing we're going to look for is we're going to look for opportunities to sell calls on up days. Now, because these stocks are already doing well, they're already in uptrends. And we're going to wait for, let's say, a day when what I call an impulse day, a big up day. And we want to find days like 2% or greater. That would be considered a good up day. Or if our stock has reached, let's say, a target level, maybe the level that I have chosen that I thought would be a good spot where I might think about taking profits. Or that level could be, let's say, a 52-week high, like the example I just showed you, or maybe it might be a previous area of resistance. Some of you might know that is something called a supply zone. So let's go back to our portfolio and let's look at Alcoa. So here's a chart of Alcoa, and this is a daily chart. It's over the last 6 months. And this purple circle here represents the day of our webinar. That would be our entry day. And you can see that we've been in a nice uptrend since the beginning of the year. So I'm going to change this to a weekly chart. And again, I'm really kind of just showing you this uptrend. We're going to come back and break this down. But now price has gotten up to, I've got a significant amount of profit in this stock. And is there an area where I might be concerned that price might reverse from? And so if I look at even a higher time frame, this is a 20-year chart, a monthly chart, you can see that we are coming into an area on an all-time basis of a potential area of supply, or potential area of where we might anticipate prices will slow down or even find some resistance. And that area looks like it's somewhere between roughly around $90 to the upside of $100. And that's why I chose this green line. I'm just marking it to show you where that is. So in this case, we've had nice profit in Alcoa, and now I'm reaching a target that I have set maybe earlier in the year. Said, hey, if I can get closer to an all-time high, in this case, near $100, then that would be an area where I'd be interested in taking profit. But I don't want to get out of the stock. What if Alcoa goes higher? Now it might. This is where we could use this no-collar strategy. So the next concept about choosing a covered call is we're going to sell when our implied volatility ranks and percentiles are elevated. Now, the reason why we do this is going to give us an opportunity to sell inflated premiums. So again, let's go back to Alcoa, and let me start at down here where it says Options Overview. And I can look and see where my implied volatility rank and percentage is. Well, let's go back to this chart here for a second. So this webinar was originally designed for back in March 21st, week of March 21st. And so what I did was I took some screenshots of the options that were the ones I was going to choose based on price action back in March 21st. And this is kind of cool because now we'll be able to see it run through maturity. And so here you can see, here is March 21st, and there's that big up candle, right? Again, a big price movement on that particular day. And then on that day, I think we actually saw the price of Alcoa go up about 8%. Well, we can always check. We can come back in here under says price performance, and I can go back and see, you know, about a month ago, how far his price has gone, and see what that value would have been. Let's go back to our options overview history. And on March 21st, you can see that our rank was at 69% and our implied volatility percentage was at 96%. Now, what does that mean? Well, that means that over the last year, 96% of days volatilities were below the volatility of that March 21st. In other words, this is one of the highest volatility days. If I go to the history of it, you can see that, you know, back in March 3rd, that was where we had 100% rank, or 100% our implied volatility. And that implied volatility at that time was 77%. Our March 21st date, let's see, where is it? Right here, was 72%. Again, very elevated. That's going to create greater premiums for us. The next thing we're going to think about is we're going to choose a strike price that is at least 5 to 10% above our current price. Again, this is going to be a twofold effect. First, that if I say I pick a 10% strike that is high enough, in other words, if price moves up, I'm still going to make a nice profit from current price in case that strike is called away from me, in case that call is called away from me. Now, this is the limiting aspect of the collar, right? It's kind of going to limit our potential. If, you know, Alcoa runs up 50% in the next X amount of days until that option expires, then we would lose that potential. But that's why we're kind of going to use 10%. I think that's a nice number to kind of look for. And the second part of this is it should be able to generate enough premium for us if we do that timing and elevated implied volatility and waiting for those up days to pay for the premium protection that we're going to want from our strike for our put. And then when we pick our put, our put is going to be in line with our strategy of our stop loss level. In other words, if I was going to say, where is this trend going to change? The next element I want you to kind of concentrate on is we're going to pick shorter dated options, something inside of 40 days. Now, the effect here is that because inside of 40 days, we're going to get a greater theta decay. In other words, the option is going to start wasting away. Now, let me just take a time out here. There are institutional traders who do collars, and they will look at much longer dated options. They might look out to what were called leaps, long-term options, out a year, maybe a year and a half, 2 years. But for us as an individual trader, this might not be suited for us. Yes, a longer time will create more premium. That might be more monies for us to collect to be able to buy puts. Most of those institutional traders will sell these longer term options, take that premium in, and then they will buy a put of their entry level. Now, if we think about this, for us, if we're trying to decide a long-term strike price, let's say 50% appreciation, again, I might be giving away over a course of a year, I might be giving away a lot of potential profit. That might be difficult for me to pick that value. And the other part is, as our stock is rewarding us, as our stock is trending higher, if I still have that put that was my entry price, if I go to try to make some adjustments, I'm going to have to pay more for that put adjustment. And so what could happen is every time I make an adjustment, I'm going to start taking away from that credit, and I might end up paying more in put protection than the credit that I took in. So I wanted to show you kind of more of a simpler way to do this. And in this simpler way is going to allow us to be a little bit more flexible. We're going to be a little bit more hand to mouth. We're going to be a little bit more timely in terms of what is going on with our markets. And again, our object is to sell enough premium to pay for our protection. And then finally, what I want you to kind of think about is, in order to judge if these values are inflated enough, we want to look to try to capture about 1.5% to about 3%. And that'll be our threshold. Every trader is going to have a different threshold. 1.5 to 3% of our current price. Now, again, if I have a low volatility stock, that premium that I'm going to collect might be lower. If I'm looking at a shorter dated option, let's say a weekly option, then that might be a difficult threshold to achieve. If I'm going to do a longer dated option, let's say 60 days or 90 days, then I definitely want to capture more credit based on this price percentage. So this rule here of 1.5 to 3% is based on basically a monthly time frame. So if I'm looking at a 60-day, then we probably want to get to a threshold of around 3% or 5%. If I'm looking at a 90-day, then it would be 3 times that. So again, this is kind of just a guideline for you, right? Also, when you start looking at your strike selections, if you're not getting this value, you might be picking a strike that is too far away. Now, that might be a good thing, gives you a lot more upside potential, but you might not be able to collect enough premium to buy that put protection. All right, so let's do this. Let's go back to Alcoa. And let's go back to our chart. And again, here's March 21st, and here's our big update where I think Alcoa was up around 8 or 10% on that day. And there's that $100 strike that we're thinking about. Now let's start thinking about our put selection. So the first rule we're going to start thinking about in our put selection is we're going to pick the same expiration now. This is going to make it simple for us. Again, there are variables to the strategy. You might sell a longer dated call option, and then you might buy a shorter put, and then you make that adjustment, let's say on a bi-weekly basis. But again, every time I buy a new put, I'm going to be spending more money, and I might run out of that credit that I'm going to look for. So picking the same expiration date just makes it a little bit more, in terms of accounting and logistics, makes it a little bit easier for us, and certainly timing as well. So the next thing we're going to do is we're going to look for a strike price that is in line with a significant low or a trend line or a moving average. And again, here, these are just kind of suggestions. I'm using monthly or weekly. So let's go back to our chart. So again, this is a daily chart, 6 months data, daily chart. But let's change this to a weekly chart. This is a weekly chart. And we can see on the week of starting March 21st, the previous day's week's low was around $70. And that would be a put value that I would start thinking about. Not only is that an important value as last week's weekly low, but if we go back about 4 weeks, in other words, on a monthly basis, there's also the monthly low. So this takes on a significance for us. But on the day of March 21st, Alcoa was trading close to $90. Now, if I pick a strike at $70 to protect my profits, think about this now. If Alcoa fell in price back down to $70, where that put would become in the money and would give me that protection in case it fell even farther, I've already lost over 20%, probably a little bit too far away because of this impulse move that we just had. So now I want to start thinking about a put strike value that's a little bit closer to current price. Now, how could I choose that? Well, again, it could be off of a significant low. And in this case, if I look at this daily chart here is that Monday spike up, and we could say, well, let's say if it fell below this week's low, and that would be somewhere around $85. Or I could look at these last two impulses. This one left a gap right here around $78. Maybe right around here, $80. So $85, $80, $78. These are all levels that I can start thinking about where I might put on that put strike. So now I have an idea of where I want to set my put. Now I'm going to look at the credit that I received based on the call that I'm going to sell. In this case, we've decided we're going to choose the $100 call. And then I'll decide how much credit I'm going to take in and which one of those puts makes sense to me in terms of their costs. So this is where we get the benefit of looking back in time and seeing what is going on today. So here's a snapshot of our portfolio from March 21st, and you can see that Alcoa was up significantly. And again, I wasn't sure how much it was up at the point, and you can see that on that day it was actually up 10% on that day, a huge, big price movement. And when I took this snapshot, the price was trading around $90.77. And you can see that it represents about $2,300 of profit in our portfolio. And here is the $100 strike for the calls. Now, if I looked at the May 20s, I could have at least gotten $6. If I looked at the April 14th, well, $3.15. That would be, at this juncture, that would be a value that I could start thinking about of credit that I'm going to take in. Now, unfortunately, what I didn't do was I didn't take a screenshot of the put market, but we can go back and in here where it says options prices, and here is our April 14th expiration options. If I come up here where it says screen, I can find those different puts. For instance, let's look at that $70 put. Now today it's not worth anything, but if I go over here, the three dots, I go to price history, and I go back to March 21st, down here, you can see that that $70 put that we decided was too far away was only trading in around 70 cents. Remember, I have $3.15 worth of $3.15 worth of credit. So we go back to our options prices. And I can see, like, here's the $85 put. If I go back to March 21st, that would have been the weekly low. March 21st, looks like it cost me $4. So in other words, that should be a capital outlay. So maybe I can find a put value a little bit lower. And that's why I came to the conclusion of looking at the $78 put. I'm going to go back to price history. March 21st, $78 put was going for about $1.90, $2. Remember, we're selling a call, $100 call, that is going to bring in $3.15. So here's an opportunity for me to sell a higher strike call, bring in capital, bring in credit, buy a put, and still put money in my pocket. And that might be important for me at a later date. And we'll talk about that in a moment. So again, let's go back to our chart. Pardon me, I went to the option chart. And there's that $78 strike. Is that as significant for me? Is that a value that I feel at that point might give me a little bit more protection? Yeah, I think it does. Right? I could have maybe picked the 80. I think if I'd looked at the 80, it would have been right around parity for the call that we would have chosen. Now, what's nice about this is, think about this. If Alcoa does go down to $78 after it got up here to just falling short of $95, if I was using a stop loss process. In other words, I put in a stop that says, hey, if price broke this trend and I felt that that trend break was below $78 and then price got below there, you know, if I had to follow my rules, I would have to exit that trade. But because we have an option, remember, an option is a right and not an obligation. We don't have to exercise that $78 put. Now, how many of you have put in a stop at a value and then the market comes down, stops you out, and then runs back up? If I asked you to raise your hand, I think everyone in this room right now would raise their hand. That has happened to you. What a put does, it gives us that flexibility, that option, so to speak, that we don't have to exercise. And what could happen is Alcoa could come down to $78, hold, and then rally back up. And I would still be in that market. Now, if Alcoa fell, let's say all the way back down to $70, I don't need to worry about that. I don't have that emotion that I'm losing money because I have the right to sell that Alcoa at $78. So this flexibility that options gives us, especially on the put side, is really beneficial, and we don't get stopped out or whipsawed out if we use a mechanical stop. And the final thing is, as we move forward, just like we would use in our profit protection plan in a regular trade, we always want to try to raise our put as we move forward. You never want to drop our put value, right? In other words, we're going to use a trailing stop using our puts. So again, if we go back to our Alcoa and we look at what is going on today, now Alcoa, is it having an up day? It's up 2.5%. So this would be a good day for us to sell another call, especially because both our call and put are going to expire tomorrow. Our April ones are going to expire tomorrow. So let's look at rolling out to the next month. And we want to roll up, right? We want to roll up to at least from 78, maybe higher. Now, we don't have the option of taking a $78 put, but we do have an $80 put. Now, that $80 put today looks like it's going to cost us around $4.50. So now what we want to do is we want to pick a call that is going to help cover that cost. Now, if I use that same $100 call that we used before, notice that it only brings in $2.30. Probably not enough to pay for that put. But if I pick, let's say, the $95 call, it's around $3.50. Now, again, this is less than what the put price is today, the $80 put. But remember, when we first did this trade, we sold one for $3.15 and we bought one for $2. So we put that $1.15 in the bank. And so today, what I could do is, because I still have that $1.15 credit in my bank, I could sell the $95 call, collect the $3.50 plus the $1.15 that I already have saved up, and that would certainly be enough to pay for that $80 put. And so what makes this strategy work well is, as time goes on, if I can start selecting calls that are going to give me just a small amount of credit after I pay for the put, and I start banking that credit in opportunities like today, I don't worry about having to pay a small debit because I already have that credit banked up. Now, is $95 call a good call value based on our theory? Well, first of all, what's our implied volatility? Here's our historical. Here's our implied volatility. We are a little bit elevated, right? Where are we in terms of our ranks and percentage? right? Maybe not as high as we would like, but certainly at the high end of our percentile. Maybe not where we would like to be on the rank. If we go back to our chart, is $95 call going to be a good call value for me? Well, again, I'm thinking about how far is price going to have to go for in the next month. Well, we're trading around $85. I picked a $95 call. That is more than 10% away, so that works. I'm going to take in $3, right? And the current price is around $85, so that is certainly more than 3%. And if I look at my chart, notice here that, yeah, that $100 call value that I saw, that supply zone that was way back in 2008, if we change this line to $95, notice how it lines up with these highs. So I feel comfortable selling this call because this now represents an area of supply, an area of resistance that Alcoa might struggle with the next time it gets back up here. So it fills all those characteristics that we wanted, all those rules we wanted. So this would be a great opportunity for us to roll out of that position that we put on a month ago today and put that position on again. So now I have protection to the downside, and I've also now kind of capped my profit on the upside. All right. So that was Alcoa. I wanted to kind of show you that how it played out, and how it played out really well. But let's go back to our portfolio. I do see some questions popping up, and I will get to them. Again, so here's our portfolio, and you can see our number one performer is Mosaic. And just before we move away from this, some of you might be curious about how this portfolio was designed. This is a dollar-weighted portfolio, so we're basically invested $5,000 in each of the 22 stocks, and that's why you can see the entry value was around $110,000, 22 times 5. So every one of these stocks, original market value was around $5,000. But you can see Mosaic is almost up, $9,300, almost double what we put in. And so it is a significant part of our portfolio. So this would definitely be one of those candidates we want to start looking for ways to lock in some of these profits. Okay, so again, here's our chart. And this is a daily chart, again, 6-month daily chart. And you can see our stock has been trending really well. Now, what I did was here, this green line represents a 20-day moving average, and the black line is the 100-day moving average. So again, moving averages, sometimes we can use them, or a trend line. And if I go to my weekly, do that weekly monthly assessment. So for this week so far, here is our low. Let me make this a little bit bigger for you. Our weekly low is just a little bit above $70. Previous week's low is around $65. So I want to start thinking about maybe finding put protection somewhere between those two weekly lows. Again, if I'm at $75 today, currently trading around $75 today, how much do I want to give back to give protection? $65, that's what, about 15%? Maybe that's too much downside. And $70 is probably a little bit more realistic in terms of how much I want to protect on the downside. In this case, what's that, about 6-8% downside protection? So that would be more desirable in this case, right? Where is my target? Well, if I go back to my chart, right, I don't really see anything over here. There's nothing for me to look for. But again, if I go to a higher time frame, here we are on a monthly chart, you can see that, yeah, we are currently coming into an area where we would anticipate price struggling, and certainly we can see it popped above there and is testing that level right now. But even at a higher level, you know, around $80, that would be another level that we could start thinking about targeting in terms of profiting. So somewhere between $75 and $80, we're going to start thinking about is our targeting value for our call. We know that we're going to look for a $70 put. So now we just need to do the walkthrough with the math. So back to option prices. I'm going to go to the 1 month out. My $70 put looks like it's going to cost me somewhere around $4, a little bit more than $4. My $80 put is right there at $4. So I could definitely do this. Now, Mosaic is down today. But yesterday, it was up. Excuse me, not price overview, price performance. Let's go to price performance. Yesterday, Mosaic was up 2%. That would be a good day to look to sell calls. Go to my May 20th. Here's my $80 call. Today it's worth $4. If I go back and look at where it was yesterday, when Mosaic was up, excuse me, I did the puts. I apologize. Let me go back. I do that occasionally. When I do these side by sides, it's always to the right. If you have them stacked side by side, so I have to go over here. I apologize on that one. Let's look at our historical on our call. And yesterday, at the end of the day, that call was worth around $4.73. Again, that's how much credit we could take in. And we said we wanted to look at the $70 put. Even today, the $70 put is still trading around $4. We could have done it one day at a time. But if we go back and look at the history on that one, again, on the right side now, yesterday, that put was, at the end of the day, was around $4.17. So again, we probably would have been able to collect, you know, an extra 50 cents or so. That would have been credit we could stick in the bank that we could use for the next time we go on a roll. And now, as a portfolio manager, I feel very confident that if I get exercised on the upside, that $8 call, I'm really selling in an area where I probably would have looked to take profit. If the price backs off from $70, $75 today and falls below $70, now I know I have protection below $70. Okay. Again, this is kind of just a simple process. I hope you guys got a little bit out of this. I do see some questions popping in here, so let me take a moment to answer these questions. Gene, any generic questions you want to answer?
I'll tell you what, I'm going to do something a little bit different here. While you review the questions I've sent you, John, I'm going to take a little poll. We're kind of interested to find out whether all of you who are attending our webinars, whether you are actually members of Bar Chart, if you're a premier member, if you're a free member, or if you're just visiting. So I am going to pop up, I hope I'm doing this right. I'm going to pop up a poll on your screen. Are you a Bar Chart member? And if you don't mind just giving us a little feedback, I sure would appreciate it. And John,
right,
whenever you're ready, you can go ahead with your answering questions.
Okay.
Thanks, everyone.
All right, so Dan asks, aren't volatilities down on large updates? No, volatility is a price movement. The greater the price movement increases volatility. It's kind of a misnomer. Sometimes folks think that volatilities just rise only when the market goes down, but volatilities go up when the market goes up too, especially when you have big price movements. In the example of the Alcoa, we could go back and look and see how much the volatility increased from day to day. I mean, let's do that, because remember, Alcoa was up 10% that day. And look at that, Dan. The previous day, the implied volatility was 65, 66, and on that 10% price spike, you jumped 7%, 6.5%, right? 6%. So up day, increase in volatility. But good question there. Richard says you look at open interest and volume when making an option selection in terms of the strike. So Richard, yeah, you can do that. There are some theories beyond that the larger strike volumes and open interest will attract the market. But in this case, I think you really want to just stick to our chart, looking at where we want to buy protection at, and looking at where we want to sell calls in terms of reward targeting. And we don't really worry about it. Now, what could happen though, Richard, is that, for instance, like in the Alcoa example, as we were gapping up higher and we were running into $90, the $100 strike might not have had a lot of open interest or volume because it was just so far away, maybe let's say a week or two ago. So if you waited to do on that process, you wouldn't have picked that strike because there would have been any activity, right? But who doesn't say we can't be one of the first ones in on a strike, right? As long as the price works for me, as long as the math of the premium I'm going to collect versus the put that I'm going to purchase. So Gina asked this question is, are we buying a put and selling a put? No, Gina, what we're going to do is we're going to sell a call above current price and buy a put below. That's going to cap our profits on the upside, but it's going to also allow us to take that income to buy protection to the downside. So another question that comes in here says, is it a good plan to put on collars every time one goes long a security, or is it better to wait for some movement? Yeah, I think what we're really doing here is we're talking about portfolio protection. And again, if we go back to our portfolio, this is already after a lot of these stocks have now generated a large amount of profit. What's one of the adages that you all have heard, right? Let your profits run and cut your losses, right? So what this strategy we're going to employ is after we start seeing our profits run. What we're trying to do here in this case is protect ourselves so that we don't let a $4,000 winner turn into a break even or a loser. And I see a lot of traders do that. They don't use any kind of strategy to protect themselves, and they let this nice winner, give back all of that profit or a large percentage of that profit. Okay, so yeah, I would think you would probably be more inclined to use this particular strategy in a stock that has already appreciated a certain percentage. Again, we're really kind of thinking about in terms of our chart. Remember Mosaic, right? If we look at Mosaic's chart, and I look at over, say, the last year, I mean, this thing is parabolic, right? It's just gone from, low 30s to, it's almost doubled in a year's time. And remember, our green lines is representing that area of historic resistance. So has Mosaic gotten to a point where I would normally think about taking profits? Yeah, it's doubled in value and it's come into an area of supply. So now what I can do is employ this strategy. This will allow me to stay in the stock in case, hey, Mosaic maybe could go even higher. Let's look at Alcoa. And this is why we want to let these things run. Alcoa was a $6 stock less than 2 years ago, and now, right, here's 2 years ago. It was a $6 stock. Now it's trading $100. Think about that in a multiple, right? Okay. All right, great question, guys. Let me see, there's a couple more here before we end up. So Jeff asked, for cover calls, do you need to own 100 shares per contract? Yes, you do. In order to do it as a true cover call, you need at least 100 shares. And I see another question about that. So again, Gina asks, do you buy the put first or sell the call first, right? So Gina, again, timing wise, we really want to wait for those up days in the calls. We're going to sell the call and buy the put at the same time. What if I waited? Let's say, okay, I feel like the stock is going up and I'm waited. I sold the call and that put that I could have bought was around the same value that I sold the call on this up day, but I waited and now price is starting to fall. Well, what do you think is going to happen to that price of that put that I waited to buy? It's probably going to go up because now price is starting to move down. So timing wise, I think you want to do both of them at the same time. All right. So Lee asked something in the aspect of, could you roll up your call in case it looked like it was going to be exercised? Yeah, you could definitely do that, Lee. Just remember that as you roll up that call, it means you got to buy back the call that you bought, and that might add cost to rolling up. So again, if you do this correctly and you're using, let's say, a higher time frame targeting, again, that's why we want to be a little bit more realistic in terms of our targeting. What you might do is let it be called away and then wait for the market to pull back and get back into that stock, right? Or what you could do is you could do another covered call trade, but it was just a pure cover call trade. In other words, you're going to buy the stock and sell that higher call. So what happens is you get exercise on the one that's going to take those 100 shares away, but you're still in the market and you sold the other call. Now, again, that's a little bit more complicated. And again, there might be some costs, capital costs on that one. All right. Okay, so I think most of them answered a lot of those questions, and we are running out of time. If I didn't answer your question, please send them to support@barchart.com. The guys there are great, and if they can't answer the question, they will definitely send them to me. All right. All right, so what are some takeaways? Again, we're going to pick a call selection that would be more in line with our profit targeting expectations. Again, areas of resistance, targeting where I would have thought about taking profit anyways, after my stock has already appreciated. Want to make sure that our call premiums are large enough to offset the put protection that we're going to use. We don't want to look at puts that we're going to buy as a profit-making opportunity. These are insurance for us to protect us in case market does something crazy, reverses in price very quickly. I see a lot of traders do this. They do this strategy, they collect the premium, now the market starts to fall, the put starts to become more valuable. Let's say it goes up 50%, and they say, oh, look, I bought this put, now it's worth 50% more than I bought it. And they sell out the put, and now they have no protection, right? Now they could put a stop in the market and collect that profit. If that's what you want to do, that is fine. But you are giving away your protection, right? And maybe you would buy another put based on the profit of the put that you just bought. But remember, now price is falling. Those puts that are going to be close to where you want to get that protection might now be more than the put that you just sold. Because remember, time is now run away and it's going to lose some value. And then finally, this concept that our no-cost strategy's purpose is to protect our portfolio at zero cost to us. That's what we're trying to achieve with this minimal opportunity costs. In other words, how far will we sell our call to lock in that potential profit if the price goes higher? Okay, so I hope you guys enjoyed today's session. Let's just do this. I want to remind everybody that there are some features here, especially some of the features in the options. I think option screening, we need to be a premium member. Is that true, Jean?
The option screeners, yes, you do need to be a bar chart premium member. And I just sent all of you a link in the chat window. If you're not a premium member and you want to try us out for 30 days, we have a 30-day free trial. So you have nothing to lose to try and look at all of these concepts that John just presented for you today.
All right, so let's talk about next week. And so next week, I'm really kind of excited about this one, is we're going to take a look at the cannabis sector, the cannabis industry. Now, I know there's could be some jokes in there, or there's some issues with legalization, and so there's a lot of risk still in this sector. But what was really kind of interesting as I was doing my homework on this one, that in any sector that I've ever investigated or done some research on, this is one of the most diverse and fragmented industries that I've ever encountered. Not only from the growers to the retail sellers to pharmaceuticals to the service companies to the technology companies that provide technical support to the cannabis industry. So what we're going to do is we're going to look at the cannabis industry. We're going to break down the different segments, the fragmented segments. And what I'm going to do is I'm going to kind of just give you an overview. It's going to be a little bit different than a webinar that we normally have. And then at the end of the session, what I'm going to do is I'm going to try to find 3 or 4 or maybe 5 of individual stocks that are represented in each one of these fragmented segments inside of our cannabis sector that could be poised for some good potential gains as long as the hurdles that face the cannabis sector start coming down. But there are even some of them in there, I think, that will do well on a long-term basis, even if the federal hurdles are not lowered. So I've done a lot of research on this one. I would guess close to maybe 50 or 60 hours worth of research on this one. So I think you guys are really going to enjoy this one. I'm really kind of proud of what I'm going to present for you. It's going to be a little bit different than what we normally would do in one of our webinars, less about a lot of the tools that we have in Bullet Chart, but we do have stock market ideas on cannabis stocks, and you can go in there and look at them if you want to do a little pre-work before we have this webinar session. Okay. Anything else, Jean? Oh, I know what you want me to talk about.
A few other things I do want to talk about. Very top of the page that John is on our webinar recordings page, you'll see in yellow a little highlighted message, bar chart webinar notification. We do send out emails, and if you want to be the very first to know next time John opens up registration for a new session, just put your email address in there, click submit, and you'll get notification from us as soon as a new webinar is announced. We also have a YouTube channel where all of John's webinars are archived. They're archived here on the bar chart website, along with, John, click on the archived webinars tab down there. Whoop, nope, whoop. Okay, you can do that. There you go.
Or
and
here.
Right, so today's session, the recording's going to be up there in a couple hours. But John, go ahead and click that watch now on today's session. You'll also be able to download the slides that John presented right there, right at that link at the top right of the session. So either watch it here or watch it on YouTube, subscribe to YouTube, give John a thumbs up if you enjoy his content, and we hope to see you next week.
Excellent, excellent. Gene, thanks again for making today's session a great session. I want to wish everybody out there be safe, good health, and the good of all trading.